Mark, you're not worried?
Longer term, or I should say medium term, maybe I'm not worried. Look, I want to emphasize the core view here is that we are in an AI bubble, specifically an AI capex bubble, and at some point it's going to burst. It's going to burst nastily. Is this the burst? I strongly don't think so. We've talked about in the last couple of weeks that at some point we're going to get into the more volatile part of the bubble. It's not even clear we're in that yet. Bear in mind, this sell-off is really mild at the moment. There's no reason why it can't continue from here. But to put as a comparison, between October 1999 and March 2000, the NASDAQ 100 had more than 10% plus sell-offs and a gazillion other 5% plus sell-offs, while the index doubled in just 6 months. So that was the kind of volatile final stage before it then peaked out and then kind of collapsed. And that is what a similar kind of playbook to the AI. Obviously not the exact same parameters. I think the cycle is quicker this time and much less volatile. So I don't expect the index to double from here. I don't expect to have as many big drawdowns, but I expect us to get into a more volatile stage of the market. And maybe that's what we're entering now.
OK, good morning to you, Mark. Let me ask you about the link between stocks then and other US assets, and specifically the dollar. If we do see sell-offs in US stocks, and let's assume they're just they're small sell-offs, and then we go back to the strength that you've been describing, Mark. If we see that, how does the dollar respond, do you think?
I think the dollar is going to strengthen into year end. It's not going to be some kind of parabolic story. The positioning is relatively flat. I think there's a little bit of upside for yields amid the uncertainty about what the Fed will do next. As soon as stock markets start bouncing again, it seems hard to be cutting into a financial assets bubble. There's not sign of the economy falling off the cliff yet. There's clearly divide in the Fed. So I think there's potentially a little bit of upside for yields. Positioning's relatively flat. I think if we get extreme risk aversion, so let's say we see the stock market sell off another 5 or 6% here over the coming days, well, then we'll see a little bit of a dollar boost from risk aversion, just a deleveraging phase, not because they believe in the dollar longer term. On the flip side, because this is an AI bubble, it'll be the AI stock market that bounces first. And as I said, I don't think we're at the final end, so I expect we'll have another bounce. And in that bounce, it'll be US stock market that bounces first, and that'll support the dollar for inflows. So overall, into year end, I expect the dollar to be strengthened, but not be a dramatic trade.
Mark, bond traders love to say that they lead the stock market, that the stock market responds more to bond moves. When it comes to the AI theme, though, we're seeing a lot of the mega cap players start to issue debt that credit investors are gobbling up. Is this a moment where the stock market is leading the bond market?
It's a great question, Kriti. I am massively in the camp that fixed income traders lead equity traders in the longer term. But I think in this cycle, it's clearly equity traders that have the lead. And, maybe I was too young to register. That's what happened in the dot-com bubble as well. But most of the intervening period, it has been fixed income that's led. But right now, it is all about AI. And it's the equity traders who know that it's unlikely to be the bursting of the bubble yet. We're not seeing the fundamental catalyst for that bursting to happen. And therefore, stocks lead fixed income for now.